Welcome to Breaking News to Trading Moves. Our goal today is to walk you through the latest market developments using the intelligence you've provided. We're looking at the cybersecurity company Palo Alto Networks, ticker PANW.
That's right. They just came out with what looked like a really solid quarter. They even raised their full-year guidance.
But the stock traded lower. And that's the paradox, isn't it? That's what we need to figure out.
Exactly. The whole story here, the tension in the market, it isn't about their operating results. It's about a very large strategic move.
You're talking about the acquisition.
I am. The reported $3.35 billion acquisition of a company called Chronosphere. And this deal, which is seen as being priced at a premium, says a lot about cybersecurity, cloud infrastructure, and maybe most of all, about AI readiness.
So here's what we'll do. First, we'll get into the specifics, the numbers, the M&A concerns that had the market worried.
And then second, we'll look at which companies might actually benefit from this. Tickers included, of course.
And finally, who might be facing some headwinds now that the industry is pushing more towards these big consolidated platforms?
Okay, so let's start with the numbers, because that's where the confusion for some people began. Palo Alto Networks, they actually delivered pretty impressive growth.
How impressive are we talking?
Their revenue grew about 16% year over year. That came out to roughly $2.47 billion.
Okay, and earnings.
Adjusted earnings per share were around 93 cents, which was a little bit ahead of what analysts were expecting. And they even nudged their full-year outlook up a bit.
So on paper, that's textbook stuff. A successful quarter in what's a pretty choppy environment. What could possibly outweigh all that good news?
It really just comes down to the price tag of Chronosphere. When a company with solid results like that sees its stock dip, it means the market is focused on one thing: capital allocation risk.
$3.35 billion. That's a lot of capital.
It is. And paying that much for an observability specialist at what's called a rich revenue multiple, it's a big statement, but it also creates immediate concern.
Before we dig into those concerns, let's just clarify what observability even means. Why is this capability suddenly worth billions of dollars?
It's a great question. You can think of it as the eyes and ears for modern software. In the past, security was all about firewalls, about the network perimeter.
Castle wall.
Exactly. But in the cloud, everything is spread out. It's always changing. Observability is being able to monitor the state of a whole system, the apps, the infrastructure, the data, by looking at all the data they produce. We're talking logs, metrics, traces.
So it's not just about stopping bad guys. It's about making sure everything, your AI models, your cloud apps, is actually running the way it's supposed to.
Precisely. And with AI, you're processing just enormous amounts of data across these really dynamic architectures. Observability becomes the foundation for, well, both reliability and for automated security.
So Palo Alto's betting that you have to own that data layer to build the security platform of the future.
That's the bet. That $3.35 billion reflects just how important that underlying data infrastructure is seen to be.
Okay, so let's get to the market's reaction. Even with that strategic logic, the stock went down. What are the two main fears driving that?
The first one is what traders just call deal fatigue. This is not the first big acquisition for Palo Alto Networks.
They've been buying up companies for a while to build out their platform.
For years. So when you add another multi-billion-dollar deal into the mix, traders start to worry about management's focus. They ask, how many big integrations can one company handle at the same time without getting distracted?
And the second fear is integration risk. Is putting a tool like Chronosphere into your system harder than, say, buying another security vendor?
It can be, because it deals with a huge amount of real-time data ingestion and analysis. That's a different beast than traditional security tools.
So the challenge is technical.
It's a very complex technical effort, weaving Chronosphere's data engine into Palo Alto's platform without causing problems, all while still trying to expand your profit margins. That's tough. And until they prove they can do it, that risk is going to hang over the stock.
That sets up the rest of our conversation perfectly. Even with Palo Alto Networks, PANW, facing these short-term headwinds, their move shows that enterprise spending on cloud security, observability, and AI is not slowing down.
Not at all. So which companies get to capitalize on that trend without taking on that immediate integration risk?
Let's start with the most direct group.
You have to start with the other cloud security platform leaders. Palo Alto's own numbers confirmed that enterprise money is flowing into modern platform-based security for cloud and AI. And that's great news for their competitors.
Who comes to mind first?
CrowdStrike, ticker CRWD. They're at the top of the list. They lead in cloud and endpoint security, and they put a heavy, very visible emphasis on AI for threat detection.
So the market sees them getting the benefit of the spending trend.
But without having to deal with a fresh, expensive acquisition right now, the spending is confirmed and their operational efficiency is still there.
What about on the network security side of things?
That's where a company like Zscaler, ticker ZS, really benefits. They're a major player in zero trust and cloud-delivered network security.
And this move by Palo Alto kind of proves their point.
It validates their whole premise that security has to follow the data and the user, not some old network box. As companies modernize for AI, they naturally move toward the kind of zero-trust frameworks that Zscaler offers.
That makes a lot of sense. So let's shift back to observability itself. That $3.35 billion price tag for Chronosphere must be sending a message to investors about the value of these tools.
A huge message. That valuation sets a new benchmark. It tells the market that high-quality cloud-native observability platforms are now seen as must-have acquisitions for any big infrastructure or security company that wants to own the cloud data plane.
So which publicly traded companies are benefiting from that new math?
I'd say primarily Datadog, ticker DDOG. It's the key observability and monitoring platform for cloud infrastructure. The Chronosphere deal just reinforces the strategic value of what Datadog does.
The thinking is, if Chronosphere is worth $3.35 billion,
Then the market cap of a leader like Datadog is probably supported by some very real takeover appeal on top of its own strong demand.
and what about its competitor, Dynatrace, ticker DT?
Dynatrace is also an AI-powered observability provider right in the same space. The market suddenly views Dynatrace as more strategically important today than it did yesterday. The Chronosphere deal shows that anyone serious about supporting AI workloads needs this kind of deep visibility.
Okay, so last on the winners list, let's talk about the big cloud infrastructure giants. It seems a little counterintuitive that a software deal helps cloud providers and chip makers. What's the connection?
The connection is that Chronosphere's whole reason for being is to make complex AI and cloud workloads reliable and observable.
Right.
So if businesses are willing to pay over $3 billion for the tools to manage these workloads, it just reinforces the idea that the underlying build-out of cloud and AI compute has a very long way to go. It confirms that companies are all in on moving these specialized tasks to the cloud.
Which means we look at the companies supplying that infrastructure.
Exactly. Microsoft, ticker MSFT, is a clear beneficiary through its Azure cloud platform. Stronger conviction in AI migration means a stronger commitment to Azure's AI stack. Observability is just a necessary layer to make sure those valuable workloads run well on Azure.
And of course, the hardware provider, NVIDIA.
NVIDIA supplies the GPUs that power the AI data centers these workloads depend on. So if the market is confident that companies are spending billions to make AI workloads reliable, which is what this is about, it indirectly supports long-term demand for NVIDIA's data center products. Every dollar spent to make cloud AI work is a vote of confidence in the GPU pipeline.
Okay, now let's flip the coin. This big push toward platform consolidation and the market's skittishness around M&A risk must be creating some headwinds for other companies.
It's definitely a double-edged sword. It affirms the spending, sure, but it also raises the stakes for execution and creates a real challenge for some of the more narrow vendors out there.
So let's start with the acquirers themselves. We talked about the risk for Palo Alto Networks, but how long could that pressure last?
For Palo Alto Networks, ticker PANW, the pressure is tied directly to how well and how quickly they can integrate this. The aggressive M&A and the premium price will probably keep the share price contained for a bit because investors want to see proof that margins will keep expanding. It's not a problem with the core business, just a financial overhang.
And they aren't the only ones in this boat. We're seeing similar caution with other big companies that have recently made large acquisitions.
That brings us to Cisco, ticker CSCO. They're being viewed with some similar caution. Cisco has also made a really big push into observability and security with large acquisitions.
So investors are worried.
Investors worry if these large, more established vendors can successfully integrate these very specialized, modern, cloud-native software companies. When there's a lot of M&A activity, any sign of indigestion from an acquirer makes traders cautious.
The second group facing pressure would be the smaller point solution security vendors. Palo Alto's strategy here seems to be doubling down on the idea that customers want one platform for security, data, and observability.
And that is the core threat to these specialized vendors. A point solution is a company that's excellent at one narrow thing, like vulnerability scanning or endpoint detection, but doesn't have that broader platform.
And when big customers look to cut costs and
Yeah.
reduce complexity,
Yeah.
these smaller vendors are often the first to get consolidated out.
Who are we looking at here? Cincin alone, ticker S, is a key example. They are a security pure play, focused mostly on endpoint protection. They have to fight for every bit of market share against giants like CrowdStrike and now, an even bigger Palo Alto Networks who are both offering these full stack unified solutions.
What about a company like Tenable, ticker TENB, which focuses on vulnerability management?
They could feel the squeeze. Tenable has essential technology, but vulnerability management is often an easy feature for a big platform to add. If Palo Alto integrates a function that gives you 80% of what Tenable does, a lot of customers will just simplify their contracts. It makes it harder for Tenable to keep its pricing power.
Okay, finally, let's look at the legacy vendors, who are seen as being a bit slow to pivot. Chronosphere is built for cloud-native, AI-native environments. We're talking software, not hardware boxes.
And this is a really important point of differentiation. The market is signaling that capital is flowing to the next generation stack. So vendors who are still seen as being tied to older network hardware or who don't have a clear AI and observability story, they look a bit exposed.
Starting with Checkpoint, ticker CHKP.
Checkpoint is still largely seen as being firewall-centric, and that's kind of a legacy idea in a cloud-first, zero-trust world. To compete for those modern enterprise dollars, they need to communicate a much clearer AI and cloud observability story that goes beyond just perimeter defense.
Otherwise, they risk being seen as yesterday's tech.
That's the risk. And you could say something similar about Juniper Networks, ticker JNPR.
They have a big footprint in classic networking hardware.
A very big footprint. And that hardware often focuses on the infrastructure itself, not on the kind of distributed application level monitoring that Chronosphere provides. The risk for Juniper is being left out of the conversations about integrated AI data center security. The money is moving up the stack. What this all really shows is that the market is making a very clear distinction. It's rewarding the companies that confirm this big spending thesis in cloud and AI, while it's punishing, or at least pausing on, companies facing execution risk or who seem to be lagging in the platform race.
So we've analyzed the market's reaction to Palo Alto Networks, and we've seen that the tension really comes from balancing that continued strong growth in cloud security spending against the very real execution risk that comes with a major acquisition. The big expenditure on Chronosphere certainly validates the need for deep observability in the age of AI. And the key question for you to think about is this: how much longer will customers put up with buying separate, specialized security and monitoring tools instead of demanding a single, unified data and defense platform? That pressure to consolidate is only going to grow, and it will create opportunities and risks all across the tech ecosystem.
And remember, this content is based purely on the material provided to us. This is not financial advice or a buy or sell recommendation. This is purely the opinion of the author.